Yo, what's up, everybody? It's Wednesday, August 7th. I keep thinking it's July, but it's August. So, market gave up its early gains today. I'm not really surprised at this kind of price action. As a matter of fact, I sent out an email to my subscribers today. I said 53.60 in the S&P September futures would be a sell level. We didn't get that high. We got close, but we didn't get that high. But you got to remember all the things I've been talking about. I think it's very important. Yesterday I said, if you're going to assess my advice or my analysis, you got to go from this point forward. I mean, calling the sell-off the other day, the big sell-off, I'm not taking any credit for that. But you got to assess my outlook from this point forward, because what I'm telling you is completely opposite of what you are hearing out there. And it's not just because I want to be contrarian, and it's not just because I want to go against the crowd, although that's not always a bad thing to do, okay? But I'm explaining it to you for the reasons why I think that it is going to happen. And of course, all of the financial industry and Wall Street and the economics profession, all of their analysis is deeply based in monetarism. And they don't even have a correct understanding of monetarism, because we saw this over the past 2 years when the Fed raised interest rates. And I said that was going to be bullish because it was going to result in big interest income transfers into the economy. I said yesterday, already this fiscal year, we still have 2 months or a month and a half to go. It's $650 billion. I mean, that's bigger than defense. That's bigger than basically everything on the government's outlays, with the exception of Social Security. Okay? I mean, it's huge. And I predicted and I said that was going to happen. And so the reason they got it wrong is because I've explained in the past, they have a single variable analysis. They basically don't understand accounting. That for every debit, there's a credit. For every liability, there's an asset. For every borrower, there's a lender. Okay, so in the case of rising interest rates, the creditors and the savers, which are the creditors, basically, they are going to earn higher incomes. So there's no loss in income in the system. It just gets redistributed. And as because the government is a net payer of interest, right? There's 35 trillion of securities that are owned, not owed, but owned by the world. Those are the recipients of government interest payments. 35 trillion, okay? And they want to cancel the debt. You would have to take away that 35 trillion. How would that leave the global financial system? It would be the worst depression ever, okay? But we're not there yet. But they talk about stuff like that, which is crazy. And on the downside, when they cut rates, that is a removal of that interest income, okay? That is a draining. So if you use a swimming pool analogy, where, we had a base flow into the swimming pool before the rate increases. We had Social Security, we had Medicaid, all the big four: Social Security, Medicare, Medicaid, and defense. Then you threw in another source of flow, which were these interest payments. Now, and imagine that as a separate pipe going into the pool. You had the one pipe, which was like the four major flows. There was other things in there, of course. You got federal salaries. There's a whole list of things. If you go on the daily treasury statement, that's basically the checkbook. And if you never bought my course, Understanding the Daily Treasury Statement, for $99, it's a great education in this. But that's basically an open line item checkbook of the United States government, like who they making payments to and the exact number, daily, monthly, and annually. I mean, It's incredible. It's an incredible resource. Nobody pays attention to this except yours truly. My whole entire analysis is focused on this stuff. So anyway, we coming up to the rate hikes. We had those four major, flows or transfers: Medicare, Medicaid, defense, and Social Security. And now they, with the rate hikes, they dragged in another pipe, another source of flow, which is very, very big. Now they're taking it away. They're maybe not taking it away entirely. They're going to slowly, turn the spigot and slow it down. And everybody thinking, yeah, that's going to be fantastic. That's going to be bullish. Because why are they thinking this? Why are they thinking this? They're thinking this because they're looking again at a single variable analysis. They don't understand double entry accounting. They don't understand accounting that they look at, debtors, right? Consumers, they're not going to have to pay so much interest. So it's basically going to be money in their pockets. That's correct. But the non-government is a net creditor. We own 35 trillion of government securities, and that's being taken away. We're a much larger factor. So I keep telling you guys, we're coming into a fundamental change of monetary conditions. You're not going to hear this anyplace else. I mean, just understand, you're not going to hear this stuff anyplace else. We're coming into a fundamental change of monetary conditions. Not unlike what we saw in 2022 when it was the end of the COVID stimulus. And I even said today in an email that this could be far more enduring and impactful, because once the Fed starts cutting rates, and remember, this is another thing I'm saying, which we're going to come back and revisit. I've been saying this over the last week or so. There's a lot of things now that I've been saying that we're going to come back and revisit. But this is another one. When they start cutting rates, they're going to have to cut and cut and cut and cut. Because each successive rate cut is going to lead to slower and slower and slower fiscal transfers, to the point when we're going to go into a recession. That's another thing that I find interesting, that nobody, and I've been saying is, nobody's really predicting a recession. In 2022, they were all saying recession next year. In 2023, I was the only guy saying it was not going to happen. And now I'm saying there's a very high chance that it will happen with these rate cuts. You think they're going to learn something from this? Do you think they're going to learn? Absolutely not, folks. Absolutely not. All right, so what do? I mean, right now, you really got to go sign up for my report. But I'm a long-term investor. So when stocks go down, even if it's a prolonged period of time, it doesn't bother me. I like that. I accumulate good assets. If you're more prone to trading, you got to play the short side of the market. That means every time it rallies, you buy puts, or you buy some of these inverse ETFs or something like that. I prefer to accumulate good assets over time. It grows my wealth. And I'm happy with that, all right? So now let me segue to something else. I was watching a video today where somebody asked a question to somebody, some financial guy. Somebody asked, well, what's going on? What's happening? How come the Japanese stock market went down so much, and how is it affecting the United States? And the person who responded was some financial guy, I think out in San Francisco, and he said, it's the carry trade, the carry trade. I'm hearing this a lot. I mean, so this supposed carry trade is when, because yen interest rates were very, very low, and they're still low. Okay, I'm going to get into that. So supposedly people can borrow in yen. I don't know anyone. I've been in this business over 40 years. I have never done that. I don't know how to do that. I don't know how to go to a Japanese bank and borrow and then take those proceeds and invest in, like treasuries. Maybe big institutions do it that way. Maybe Goldman Sachs and JP Morgan, maybe they actually do that. Maybe they actually take out yen loans. But basically, if you're talking about the carry trade, which I think is kind of like a mirage, all it is really is like you're going short the yen and you're buying the dollar. And so this guy was saying, so Japan, the Bank of Japan, they raised interest rates and everybody started to unwind the carry trade. And I'm like, dude, they raised interest rates to 25 basis points from 0. So like 0.25%. And you still have 5.5% here is the Fed's policy rate, okay? So I mean, you're telling me that now they're all unwinding this trade because suddenly Japan is paying 0.25% and it's not good anymore to be in 5.5%? I mean, come on, seriously. Folks, I don't know about you, but I love to kind of sit back and listen to this stuff and just shake my head, SMH, because, here are these people and they always come, and they're all very highly educated, very highly educated. They went to the best schools. You could see their lifestyle. You could see how they had their language that they use, how they communicate, just their body language, everything. And yet they utter complete nonsense. That meant like everybody panicked out because now they're paying 25 basis points, but you still have a 5.5% Fed funds rate. Even if they cut it now down to 5%, the differential is still enormously wide, where in the past they would have looked at that differential and said, this is a monumental opportunity for the carry trade. So, I mean, come on, what are we talking about here? Look, let's be honest what we're talking about here. What we're talking about here is wild speculation. And I would say the speculation was not on the short yen side. I would say the speculation was on the yen buying, which has just occurred in the last couple of weeks. And I'm still sticking by my guns, and I'm telling you, that is going to be unwound. I was hit with a margin call. I had a big short yen position. I had to bail out, but I'm going to get back into it again. All right. Sometimes that happens. I mean, that's the landscape. I'll get back into it again. But I sit back and I listen. And it's fascinating to me because, again, I'm listening to these people who are highly educated people, wearing fine clothes, sitting in beautiful offices, maybe incredible surroundings where they are. Just talking utter nonsense. Like, dude, you don't know what you're saying. It makes no sense at all. Like, I could go out on the street right here and find some blue-collar guy and ask him about this. And I would say, Joe, let's say I saw Joe out here. Joe, a week ago, the bank was paying you 0%, and you could invest in U.S. Treasuries for 5.5%. Where would you put your money? Joe would tell me, I guarantee you I'll put my money in U.S. Treasuries. Then I go back out to Joe, a week passes, and say, Joe, guess what? The bank is now going to give you 0.25%, but you're still getting 5.5% here. Where are you going to put your money? You think Joe is going to say, oh my God, I'm jumping into that 0.25% right now. I don't want to miss that. Come on. Come on, are you kidding me? Like, Joe would know. But this guy, fancy, sitting up in his, multi-million-dollar estate in San Francisco, the financial expert, telling us that the whole entire global financial system is unwinding because the Bank of Japan went up by 25 basis points. Come on, folks. Is this stuff really hard? I mean, you can listen to this and be indoctrinated by this bullshit, by this garbage. Or you could just use your own brain. Like I said, I could bring Joe right in here. He would understand this better than 99% of the financial experts out there. I always see like expert, right? Economic expert. Mohammed El-Erian, this guy, maybe you've heard of him. A week ago, he's saying the Fed is going to make a big mistake if they don't cut interest rates right now. This is the guy who in 2022, he was saying they better raise interest rates to kill inflation. They better. Now he said last week, if they don't cut, they're risking an enormous crisis. Said that last week. Yesterday he said if they cut, they should not be bullied into making a cut. So 1 week it's like they should cut. If they don't cut, it's going to be a disaster. And this week is like, it'll be a disaster if they cut. Folks, these are people at the top of the echelon of the financial industry. Be like Joe. Or just stay here and listen to what I'm telling you. And I'm not patting myself on the back. I like to educate people. I happen to like it, all right? I mean, it's gratifying. And also, when I have to explain my ideas, it just makes me a better investor all around, okay? I mean, I have to think about the process. Anyway, that's it for today, folks. Don't forget, please like and subscribe. The likes have been going up. Thank you very much. I appreciate it. The subscribes have been going up. I appreciate it. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.